Hey friends, it's J Lobos coming back to you on another episode, and today I wanted to talk about DTIs. What is that? It's not a sexually transmitted disease, it's debt to income ratios. So for you guys out there that have maybe gone into an auto dealership, gone into a mortgage company, applied for a mortgage loan or a personal loan, you might have been declined by your debt to income ratio. So I wanted to give you guys 6 quick tips on how to lower that ratio so that this way going forward when applying for these type of loans, you're going to be eligible for it. So for you guys checking out the channel for the first time, consider liking, subscribing, because obviously I'm going to go ahead and fill you guys with a lot of financial knowledge and information so that you guys can get to those financial goals fast. So let's go ahead and dive. First off, what is a debt to income ratio? So a debt to income ratio, basically, it's a cumulative of how much debt you have per month divided by the gross income that you're receiving. So as an example, if obviously you have $300 worth in debt per month, house, income, payments, either your rent, your cars, your insurance, you divide that by how much you make per month, $1,000, 300 into 1,000 is 30%. So it's usually expressed through a percentage. That's usually how lenders see it. And usually when you're over a certain percentage amount, 41, 45, 50%, you're usually considered a high risk. So I wanted to go ahead and share with you guys 6 tips. I got it right here. Also, go into the buildworkstrategies.com website because I'm gonna go ahead. I actually have a few blogs which we've written for you guys, so you could always go back into this besides this, so you could get the real detail, the real juice as to what I'm actually going to go ahead and express. So again, one of the first things that we obviously focus on is paying off your debt early or on time. A lot of people really don't tend to notice or focus, but keep in mind, guys, the more ahead we are, the more that we budget ourselves, and the more and the much faster. So if your debt usually is something that's paid off, as an example, you have 2 dates. You have a billing date and you have a reporting date. If you go ahead and you pay your debts, because sometimes people say, oh no, I paid my debt in total, but you might be paying it after the reporting date. So in a sense, you could never change the reporting date on a credit card or on a loan, but you could always change the billing date. Make those billing dates count for you. You can maneuver those. So some people get paid every week. Some people get every 2 weeks. Some people get paid every month. So if you're finding yourself in a situation where every single month you're pressed for money, maybe start thinking about the accounts that you have and start moving the billing dates maybe to the middle of the month, or preferably before the reporting date, so that this way you're paying most of the balances before it reports on your credit. And if a lender sees the report, he's going to see that the utilization on those accounts is a lot lower. So that's tip number 1. Tip number 2, target debt with the highest bill to balance ratio. What does that mean? Example, you might have a credit card or an account with $100 balance, and the minimum payment is what? 25 bucks. Guess what? You have another credit card with a $50 balance and the minimum payment is 25 bucks. Preferably choose option number 2, which in this case, you have a 50% balance to debt ratio. So with that said, focus on the one that's the smallest. It creates confidence, it boosts confidence, and it's gonna get you guys propelled so that you guys continue to pay some of those accounts off. Number 3, ask your boss for a raise. Guys, sometimes obviously, I always tell this to people, especially on the credit repair world. Listen, it's in our best interest for us to be seeking more and more. It's in your best interest for you to be seeing these videos more and more, for us to be educating ourselves through finances and financials so that it equips us. So it's in our best interest to ask for this information, for us to ask, hey, what else could I be doing? What other credit card could I be applying for? So the same thing happens if you're in your job and you've been there for 6 months, a year, you haven't gotten a raise, nobody's spoken about it, and you're outperforming your colleagues, then talk to your boss. You know, obviously in a nice professional way. Listen, what other positions are there available that I could maybe start working towards? And what do they pay? Do they give an extra $1? Do they give an extra $4? Whatever that number is, and start working towards it. Because at the end, The more income that you're receiving, the more you're gonna be able to pay down these debts, lowering your debt to income ratio. So another thing that you could go ahead and do to lower your debt to income ratio is make a little bit of extra cash. You know, a lot of the times too, we kind of think about it. We're in a situation where we're looking to apply for a mortgage, we're looking to apply for a loan, and guess what? The only legitimate way, unless you win the lottery or somebody, you know, gives you a gift and you're able to pay some of those debts, sometimes we're gonna have to buckle down, make sacrifices, and possibly take on a second job. So right now, obviously, there's a lot of opportunities for you guys out there that have that flexibility. Maybe you wanna do an Uber, maybe you wanna do a Lyft. Besides that, maybe you wanna do something online. So there's things that you could potentially literally go through a garage, your garage, you could go into garage sales, pick up a few items, sell them for a little bit higher, and create a second little gig, another additional avenue for income so that you're acquiring more income, paying most of that debt off, and lowering your debt to income ratio. Number 5, consider also balance transfers. Balance transfers are a phenomenal way on how to attack principal. Meaning that if, as an example, Discover, they have the Discover It. I actually have a friend of mine that just got approved for $5,000. We're transferring $5,000 from an X amount of credit cards that have higher interest rates. And then we're transferring all those balances over to this Discover credit card, which is 18 months of 0% interest. Phenomenal to eliminate. Why? Because instead of hitting principal and interest, it's just straight principal. Straight principal, reducing those balances as fast as possible. Also look into a credit union. Credit unions have phenomenal personal loans, 3 to 5% interest, depending on where your credit scores are at, that you might be eligible for. Pay some of those debts off, and guess what? Hit nothing but the principal. That could lower your debt to income ratio. The last one here, refinance your debt with a new lender. Refinancing could also possibly mean something along like a car loan. Keep this in mind, guys. After 12 months of consecutive payments, depending on where your credit scores are, talk to your auto broker. As a matter of fact, let us know and we'll help you. I'll put you in contact since we work with them. But guess what? If you're eligible for a reduction on the rate, when you first got it, maybe your credit wasn't the best. After making consecutive payments, you've made all this progress. Possibly you have an eligibility to refinance your auto loan, reducing the interest rate, hitting more of the principal, getting rid of the debt faster. Also consider refinancing your property. Properties are a great way doing cash outs. Refinancing a home to pay off some of the debt could be a really good way to reducing your debt to income ratio, as well as cashing out to make upgrades on your own property, which is, it could help you out 2 ways. So guys, I hope this video was very informative. Until the next time, like, subscribe, comment, and if you found this information to be very educational, continue to share this information. And until the next time, take care.